My name is Chris Rolls and I'm the managing partner at PieLAB Capital. Like you, I'm an investor, but I haven't always been an investor. In fact, most of my life I've operated businesses. I spent the first 20 years or so running a range of businesses, 4 in total that I started predominantly from scratch. All 4 I subsequently exited at various different times over that period of time. And about 10, 12 years ago, I had a liquidity event. It was a good liquidity event. And I came to the conclusion that pretty much for the rest of my life, I needed to become an investor. And I knew how to run businesses, but I guess I was lucky to realize that running a business is actually very different to investing in businesses, and something that is sometimes lost on people that have had a good exit or a good liquidity event from running a business. And so what I did is what I always do when I get into a new industry, and that is I started learning. I'm a bit of a learning junkie. I studied private equity investing at Harvard Business School. I studied venture capital investing at the University of California in Berkeley. I studied value investing at the University of Columbia. I spoke to probably in my first 12 months 30 people working in private equity firms, not just here but overseas. And then along with all of the reading I did, I decided that wasn't quite enough, so I went and did some, I guess you'd call it middle-aged work experience in a private equity firm for a couple of years. I came across a private equity firm, had a couple of struggling companies. I said, well, how about I help you fix those companies, and in return, you show me what there is to learn about private equity. And so that's the process I went go through, and that was over a decade ago, and I've been investing ever since. And what I want to share with you today is a little bit about what I've learned on private markets, which is what Steve's asked me to share with you, because it's a really interesting space and certainly one that is growing. And I'll show you some of the figures around that, and no doubt Cameron will follow me up with some of his own figures from PEP's perspective. But as I said earlier, like you, I found myself in a scenario where I had a liquidity event. And like most people, I got some advice, and that advice was to diversify. And I was told to go and diversify. I did what some people do, and that is I invested in property. So I can just get a quick show of hands. We've got a whole room of investors here. Raise your hand if you have some sort of investment in property. Raise your hand nice and high. Interesting, look at that, 80% of the room. Raise your hand if you've got some sort of investment in public market equities, so ASX listed stocks. Okay, raise your hand if you have any direct investments in private companies. So you invest directly, a few of those people, and then raise your hand finally, the last asset class, private equity, if you have an investment in a private equity fund. Now look at that. Notice the difference there. At that, we're looking at probably 10% of the people in the room. And I constantly ask myself why. Why is that? And I'm going to show you some statistics that I learned along my journey. Because one of the things that often happens is when people have a liquidity event is they're told to diversify. So they did what I did. They go out and buy a bunch of property and they consider that diversification. Or they sometimes go to their professional financial advisor and they show them something that looks like this, the traditional asset allocation portfolio. Stick 60% of your money in stocks, 40% in bonds. Became popularised in the 1950s and was really a core tenet of financial planning for many, many years. And in fact, a lot of the institutions and endowment funds in the US adopted that type of strategy. If they wanted a more risky portfolio, they moved a little more to the stock side of things, and maybe instead of 60, they go 70, 80, 90. If they wanted a more conservative portfolio, they moved to, more to the bond side of things. When I first started, I guess, becoming a full-time investor, one of the things I did, as I mentioned, is I started learning. And one of the things I found that was really useful for me was that a lot of the public institutions around the world that have very, very large pools of capital, particularly the US endowment funds, published where they invested their capital. And not only did they publish how they allocated their capital, they also published the returns they got from all of those allocations. And I came across charts that looked a little bit like this, and some of those are a little bit small, but what you can see is a bunch of endowment funds around the world, Yale, Harvard, Cambridge, etc. And one of the things that I noticed was if you looked at the overall returns of endowment funds around the world, those that allocated more of their capital to alternative assets, particularly private equity, outperformed those that didn't. And what's really interesting is when you have a look at that chart there, you've got sort of the traditional 60-40 portfolio allocation on that top line there. And if you have a look at an average 60-40 portfolio allocation, over the last 20 years, you would have returned about 6% per annum. If you take the average endowment fund in the United States, who allocate about 30% of their capital to alternative assets as opposed to none, which the global sort of equity bond portfolio does, you'll see their returns go up a little bit to 6.8%. If you take some of the bigger endowment funds in the US, those that are over $1 billion in size, they typically allocate about 39% of their capital to alternative investments. They've returned over 20 years about 7.8%. The top 5 endowment funds in the US, they allocate 44% of their capital to alternative assets. They've returned about 11.2%. And the super endowments, the ones I call Harvard and Yale, that I call the super endowments, they've allocated the most, about 45%. And this was popularised by a guy called David Swenson, who was the Chief Investment Officer of the Yale Endowment Fund. And you can see there a very, very clear correlation in endowment funds in the US. Those that allocate more to alternative assets, particularly private equity, generate better returns. And the question I wanted to know was why? Why is that the case? And one of the reasons why is put simply, private equity returns generally better than most other asset classes. This is just a figure that I found in some of my research. The median net internal rate of return, so if you're not familiar with internal rate of return, consider it like a percentage return per annum of Australian-focused private capital funds over the last 10 years, so vintages, so funds that started from 2012 to 19 have returned 17.8%. Now that's an extraordinary return when you compare that to your typical 60-40 portfolio. And that's one of the things that really struck me. Wherever I went around the world, if you took an average of private equity fund returns, they performed very, very well. So the question is why? Why does private market investing generate better returns? There's a number of reasons, and I'm going to cover just 3 today. There are actually quite a lot, but I'm going to cover what I believe are the 3 most important. And the first of those is that there are simply more target opportunities. As a private investor investing in private businesses, there are simply more businesses to invest in, and the numbers are growing. Take, for example, this chart here. This is a chart of the total number of listed companies, predominantly on the NASDAQ and the New York Stock Exchange in the United States since 1996. And you'll see in 1996 there are a bit over 8,000 public listed companies that you could invest in on the public markets of the United States. You fast forward to 2023, that number is about 4,000. It's roughly halved over the last 30 years. The total number of opportunities as a public market investor have declined. And that's actually quite a common chart, something you see among many, many developed economies around the world. The Australian market has fared a little better. Go back 10 years, there were sort of about 2,100 odd companies. That's declined to about 2,000, so about a 4% decline. London Stock Exchange has declined by about 17% over the same period of time. Now put that in contrast to private companies, and this is just numbers from the Australian Bureau of Statistics, and these are businesses in Australia. You take the small category businesses that employ 5 to 19 people, numbers there have increased by about 13%. Over the last 10 years. In the medium category, they've increased by 20%. In the large category, they've increased by about 30%. So a stark contrast there. The number of companies listed on exchanges around the world is declining, and the number of companies in the private space is increasing. Now, why is that important in terms of generating better returns? And when people ask me that, I often sort of think that the best way to think about it is an analogy. I'm going to give you 2 scenarios and have a think about these 2 scenarios. Scenario 1 is this. If I said to you, go outside onto, I think we're on Bridge Street here, and stand on the side of the road. This is scenario 1. And count the first 10 cars that drive past you. And scenario 1 is you can take any one of those 10 cars home tonight as being your car. That's scenario 1. Scenario 2 is similar but slightly different. Go out onto the same street and count the first 1,000 cars that drive past, and you can take any one of those cars home with you tonight. Which option would you choose? You'd clearly choose the second one. Why? Because statistically, there's more chance of taking home a Ferrari or a Bentley or a Rolls Royce or something that is more prestigious than simply a random selection of 10. And that is one of the reasons why investing in private markets generates such good returns, because there are simply so many opportunities to choose from. And the smaller you go down that, choice scenario from big companies to medium companies to small companies, the more choice you have to invest. The second reason private market investing typically generates better returns is because, as a general rule, private companies are cheaper to buy. It's simply a return perspective. You pay less for an asset, you've got more potential upside in terms of multiple growth or multiple arbitrage when you buy it. And that's predominantly because of the liquidity premium. If you buy a company that's listed on a stock exchange today, you can sell it tomorrow. You buy a private company today, it's much, much harder to sell tomorrow. So as a result, you've got this scenario where more capital flows into public markets, creating higher demand, pushing prices up. When I invest in private companies, I invest at the smaller end of the spectrum. Why? For a number of reasons. One, I've got more choice, but two, they are a lot cheaper to buy. The average company that I've bought over the last 10 years, we've bought at a multiple of around a bit over 5 times EBITDA. So 5 times earnings before interest, tax, depreciation, amortization. So that's the average price that we've paid for a company. Now, the average price that you'd be paying to buy a company on the stock exchange today is about a 20 times PE ratio. Okay, price earnings ratio. Now, for clarity, those two figures aren't directly comparable. EBITDA multiple versus a price earnings ratio are slightly different, but a 20 times PE ratio, give or take a bit depending on the company, equates to maybe a 12, 13, 14 times EBITDA. So when you think about that, if you can buy one company at 5 times EBITDA, another company at 13 times EBITDA, which one is cheaper? It's pretty obvious. Private companies are generally cheaper. And that's one of the reasons why they generally return better. The third reason is this. And that is that better access to information when you are investing in private companies allows for better decision making. Now, a lot of people, when they hear me talk about this, they say, well, hang on a moment, isn't the whole point of public companies that you have open access to information? The answer to that is kind of true. But when I go and buy a private business, as do most private investors, I'm able to sit down with the sellers and I'm able to ask them about their executive team. I'm able to sit down with key employees. I'm able to talk to customers. I'm able to ask about their strategic plan. I'm able to ask them about, this key customer, how long are their contracts locked in for, and are they likely to renew that contract? I can look at their strategic plan. I can make a decision, a really informed decision, as to what are the prospects of this company over the next 2, 4, 6, 8, 10 years. In private market investing, that's called due diligence. Okay, if I was to get access to that equally secret, competitive information for a public company and act on it, that would be called insider trading, which of course is illegal. And so when I'm making an investment in a private company, I can actually make a decision that is genuinely informed about the prospects of that company moving forward, which means I can therefore make a better decision and generate better returns. And that often flies in the face of sort of popular belief. Private company investing allows you to make more informed decisions because you have access to better information. And that, in my view, are the three key reasons why private markets generate better returns than public markets do. And there's a bunch of other ones, but I don't have time to go into them today. So let's just go back to our returns for a moment and have a think about some of the things that I've just discussed about private market investing. And we'll have a look at how returns would affect you as an investor. If you're an investor, and we looked before and we sort of said in that chart that I showed earlier that the typical 60-40 equity portfolio over 20 years has returned about a 6% return. Now, if you invested $1 today at a 6% compound annual growth rate over 20 years, you would in 20 years end up with a bit over $3. So you put $1 in, you get about $3.2 out. Okay, that's the return you would get over 20 years. If you have a look at the S&P 500 over that same period of time, they've generated about a 9%. If you made the assumption you were going to continue to generate about 9%, you put $1 in today, in 20 years you'll take out about $5.6. Now, interesting, by the way, a little anecdote on the S&P 500. It's generated about a 9% return over the last 20 years, although almost 40% of that total return has been generated across 7 stocks: the Facebook, Microsoft, Amazon, Tesla, Apple, etc. So one of the interesting things that people talk about when they talk about, what I do is I invest in an index because it gives me a very, very wide spread. Just be careful about how concentrated that investment can actually be if you are genuinely chasing a wide spread of investments. So $1 in the S&P 500, assuming that you generate the same return over the next 20 years that you did over the past, would turn into $5.6 over 20 years. If you invested in one of the and got the similar returns to, say, the super endowment funds like Harvard and Yale at 11.5% per annum, you invest $1 today and you got that return for the next 20 years, you'd end up with about $9. Now, if you invested in an Australian private equity firm and you generated a 17.9% return, which the median of all private equity firms over the last 10 years has generated, you would actually end up with $26.9. So, a very, very significantly higher return for that dollar put in. However, there's a couple of nuances that you need to be aware of because these figures aren't comparable. And to understand that, you need to understand the structure of how a private equity firm works. The way a private equity firm works is they go and raise some capital for a year or two, they take that capital, and as they make an investment, they call that capital for you, and they invest that over a period of 2, 3, 4 years. They then manage those businesses and grow them over a period of 2 or 3 or 4 years, sometimes more, and then they exit it. And you might exit and get some of your capital back after sort of 6, 7, 8 years, and it flows back to you. Now, one of the things that people don't take into account when they simply look at headline returns is the fact that if you invest in a private equity firm, you get your capital back. Each time you get that capital back, you need to pay tax on that. Depending on how you're structured, if you're structured well, you probably pay somewhere around the 25% capital gains tax. So you can't actually invest, generally speaking, in a private equity fund and get that 17.9% return every single year, because periodically along the way, you have to pay tax. There's tax leakage. And that tax leakage has a significant effect. Instead of generating actually close to 27 times return on your $1 that goes in after 20 years, that tax impact actually reduces it to about half, around about 15 times. Still, a significantly better outcome than all of the other allocation scenarios. Which leads me to this gentleman here, which all of you will recognise, is Warren Buffett. If you haven't been over to Warren Buffett's Omaha annual general meeting, I would strongly recommend it because time is running out. He made a comment, he's made several comments over many years to this effect. We have a wonderful business. We do not have to pay tax on the increase in the value of our business as long as we hold on to it. The money will compound for our shareholders. And that's certainly proven. In fact, in his 2020 letter to his investors, he pointed out they had nearly $27 billion of capital gains that they hadn't paid tax on, that they were generating increasing returns on. Tax leakage has a big effect on returns. And when I started investing, I started a normal private equity firm. Our first fund was sort of like a small venture capital private equity fund. We returned about 25%, an IRR of 25% to our investors. That was all realised, so it's not a sort of a pretend return based on valuations. But we got to the end of that fund and we had to sell some really good companies. And what I found, being an operator, is if I've got a good company, I don't like to sell it, particularly ones that are growing and generating cash. And so I looked around the world at who had built businesses where they had acquired large numbers of small businesses and kept them for the long term. And I came across this group of companies called acquisition-led compounders or serial acquirers. And what I found is that most people in Australia had not heard of these types of businesses. The first one I came across was a company called Constellation Software. They are a business that started in 1995 with a small amount of capital, it was $25 million. They bought small software businesses that were kind of old school software that weren't growing very fast, so very different to venture capital investing. But what they were able to do is able to generate a lot of cash out of those investments. And they continued doing that from 1995. They listed on the Australian Stock Exchange on the Toronto Stock Exchange in 2006 at $18 a share. And this chart here shows their return to shareholders from when they listed in 2006 all the way through to 2020, just past 2022. And what you can see is that Constellation Software's return outperformed Facebook, Amazon, Apple, Microsoft, and Google. It's now an $80 billion company that almost nobody in Australia has heard of. Why? Because when you do business with Constellation Software, you don't even know who they are. You're doing business with a tiny little software business that maybe have 20 or 30 employees. You probably know the CEO. It operates in a completely decentralized fashion. And this was the first serial acquirer that they came across. They've generated returns of 34% per annum for nearly 20 years. An extraordinary return. They are the highest returning listed company in North America. Now, what's interesting is there are actually lots of these businesses. And I subsequently found quite a lot of them. And the home of these businesses is actually in the Nordic region of Europe, in Sweden, Finland, Norway. In fact, I've just come back from Stockholm a couple of weeks ago, learning more about serial acquirers, because we started Australia's first serial acquirer about 4 years ago. We pivoted away from that typical fund model where you had to sell businesses when the fund got to maturity so that we could hold on to them forever. So what is a serial acquirer? Well, a serial acquirer is a business that acquires in a corporate structure, similar to Berkshire Hathaway, potential niche market leaders. So small businesses in a very, very defined niche that are often market leaders. Why? Because it gives you pricing power, makes your customers very sticky because they don't have alternatives. What they typically have is they have a very, very simple and fast M&A process. They're able to go out, identify a good business, and close on a transaction very quickly. They run underlying portfolios in a decentralized manner. So one of the things that happens is people sort of go, look at Constellation Software. They've got they've made about 1,000 acquisitions. They must get all of these synergies by merging these businesses together and cutting out HR and accounting. The answer is no, they don't. Everyone operates with its own CEO, its own CFO, its own group of executives running just that business. And what that allows them to do is that allows them to remain nimble. Now, while investing as a serial acquirer is similar to investing in private equity, there are a couple of advantages. First of all, because they typically buy small businesses, they buy them at low multiples, and therefore they don't have to put in large amounts of debt. The typical serial acquirer around the world, even the publicly listed ones who could access a lot more debt, typically operate with less than 2 times EBITDA of debt. In private equity firms, often that's a lot more, 3, 4, 5 times. They typically buy smaller businesses. Why? As we've discussed, they buy them for lower multiples. They provide more diversification risk for investors. A standard sort of private equity fund will have sort of somewhere between 7 and 10 portfolio companies in it. You invest in some of these serial acquirers that I met with last week in Stockholm. They might have 200 or 300 or 400 portfolio companies that they've been building up over decades. If one of those businesses fails, it's kind of irrelevant. If an acquisition they make fails, it's kind of irrelevant. Last year, Constellation Software made 120 acquisitions at an average purchase price of $12 million. Now that's an $80 billion company. What would happen if one of those $12 million acquisitions didn't work out? It wouldn't make any difference at all. It's one of those things that diversification actually becomes better as they grow. And finally, the other reason why it's similar but slightly different is that they typically buy and hold companies as opposed to buy, grow, and sell. Serial acquirers are after companies that don't grow rapidly. They're after companies that generate a lot of cash. And that cash is then funneled back to head office, very similar to Warren Buffett's Berkshire Hathaway model, and that is then allocated at the highest possible returns. What they have is they have the ability to continue to deploy capital at high rates of returns for a very, very long time because there are so many opportunities for them to invest in. Okay, so why do they generate such good returns? Simply because they buy small businesses and there's lots to choose from, they cost less to acquire, they're more nimble and therefore easy to improve. And I'll give you an actual sort of example of that. We bought a company about 2 years. It was in the property services space. When we did our due diligence on it, it was a small business, had about 40 employees. We paid what was for us quite a high price. For us, it was about a 7 times EBITDA multiple. What we discovered when we did the due diligence on this business is that they hadn't had a price increase put in place for 11 years. Now, picture that in a scenario of the inflationary environment that we have at the moment. So what did we do? We bought the business, we put the prices up by a bit over 20%. We did not lose one customer. So literally within 30 days of buying that business, our 7 times EBITDA multiple had declined significantly. That business has generated a cash return of 26 per annum for the 2.5, 3 years that we've had it. That's the sort of thing that we do. It's not rocket science, but there's a fair bit of time and effort involved in finding them and understanding how to operate these businesses. That's what I mean by they're more nimble. They're small, they're nimble. Imagine buying Coles and trying to put all your prices up by 20%. It would be a physical impossibility. The other thing, of course, and the one that I referred to earlier, is that serial acquirers are able to buy businesses that compound over the long term without having to deal with tax leakage. This is a list of about 30-odd serial acquirers that I've come across in some of my research over the last sort of 6, 8, 10 years. A lot of these I met in Stockholm a couple of weeks ago. Most of them I've spoken to in some way, shape or form. Some of them are public listed companies, a lot of them are private companies. That group there over the last 10 years has a median return of 20%, a bit over 20% per annum. Now, if you want a full list of those companies, I'll show you where you can get that at the moment so you can have a look at them. This is sort of what we do. We buy small businesses. The first business we bought was in the IT managed services industry. It's a business called ID11. It has about 70% of its revenue that is recurring, so contracted, locked in, long-term recurring revenue. Quite different to most IT managed services businesses, and they're the sorts of businesses we buy. Ones that have high rates of recurring revenue. Stanshall Strata in the strata management industry, 99% of its revenue is contracted, locked in revenue. Its total churn rate of customers last year was less than 2%. Very, very stable, sticky revenue. We have an exercise physiology group. We have a smoke alarm, residential smoke alarm testing business. We have 2 businesses in fire services protection. Once again, very, very safe, stable, recurring revenue. They're the sorts of businesses that we buy. Now, I'm almost out of time. If you do want to learn a little bit more about serial acquirers, just scan that QR code, stick your email address in, and what we can do is send you a serial acquirer white paper, which I wrote, which I've sort of took me about sort of 3 years to gather all the research, which covers the sorts of returns that serial acquirers generate around the world. It has a comprehensive list of all those serial acquirers and really goes in depth into the model. Now, one of the questions that people ask me is that are we raising capital? The answer is no, we aren't. We have a small group of shareholders. It's possible at some point in the future we will. If that's of interest, feel free to get in contact with us if you're a family office or a high net worth investor, but we aren't raising capital sort of in the near future. That's it from me. I hope I've showed, enlightened you a little bit on why private market investing generates particularly good returns. It's a little bit ironic to be doing this in the ASX building, but one of the things that of course happens with small private companies is they often become very large and they list on a stock exchange where you can buy them for more than what you could have previously. My name's Chris Rolls. Hope you've enjoyed that. Look forward to meeting some of you over the course of the day. Thank you.